Hello and welcome to Property Matters, a weekly look at all matters property designed to be of interest to anyone else who has an interest in the property market. And Property Matters is supported by Fairview International Property Consultancy and Town and Country Property Auctions, London. Now, each week we look for the stories that are going to get you talking, and we'd love to get you in our conversation every Sunday morning. So please put your comments in the comments section below, wherever you're watching us today, on YouTube or on Facebook, and get involved today if you wouldn't mind. And don't forget to like and subscribe so you'll know when we go live each time we do. Our email address, should you like to get in touch, is propertymatterstv@gmail.com. So, to this week's show, we always have our regular property expert, Joe Joshi, but I'm delighted to say we're joined today as well by our mortgage specialist, Bob Singh. Gentlemen, good morning.
Good morning.
Good morning. Good morning. Good morning, Paul. Good morning, Bob. And Bob, thank you very much once again to giving up your time to join us at this hour on a Sunday morning. But so many relevant parts of this property matters subject that we cover. And one of the major parts of that, of course, is mortgages. And it's a minefield and it really needs expert advice. I always try and give a general view because I'm not qualified to give the advice that you are in a position to do. But that's why we are very grateful for your input. Each week, my learned friend on the right chases me for all sorts of statistics and tells me how many graphs he's got and what I've got to challenge. So the good news is that most of this is all mortgages this week, Bob, because Paul's been working hard trying to get you across and get us joined. So I'm really looking for a bit of a rest here. So welcome, Bob, and I hope you have a good time.
Thank you very much. It's always a pleasure to be.
It's certainly been an extraordinary year. What a year it was to launch Property Matters. Some of the stories we've covered in the 10 months or so that we've been on air have been quite extraordinary. And today is no exception. This is going to be a year we'll look back on with some real wonder in the future, I suspect, because we're breaking records every single month, it seems. And yet again, we have to report on the current situation of the market. So obviously after July, when the stamp duty holiday finished on June the 30th, HMRC reported record receipts from all that stamp duty being paid in the fortnight that followed on from the end of June. So that's fine. Record figures there, record settings. But now into August, advanced news, if you like, of Nationwide's house price index, which reported yet another rise in prices. And the house price growth grew by 0.5% to 11%. But more importantly, the monthly house price inflation rose from 0.6 in July to 2.1 in August. So just when you think the market would be reducing somewhat, everybody would be taking a bit of a breather. On the contrary, it's gone forward. And this is the second largest monthly gain in 15 years. When was the largest? Just earlier this year in April, when we had a 2.3% monthly rise. So this really is an extraordinary year. And the suggestion, Bob, is that basically this is people further north perhaps taking advantage of prices between 125 and 250, where they can still get their stamp duty relief. And of course, the other thing is that the lack of supply is still fueling this growth.
Mm. No, these figures surprised me as well because we had genuinely thought prices would start to taper off or activity would simmer down. And obviously these figures indicate quite the opposite. After stamp duty ended on the 30th of June, yes, we thought transactions will sort of taper down, but activity still seems to be there. It'd be good to know how many of those transactions were either buy to let or to live in, but certainly there was still some benefit to be attained from the stamp duty relief. So I think it's more of that and the shortage of supply that's leading to these price increases. But how long can it carry on for? I know there's forecasts that this will carry on till the end of the year. But I do feel after September things will slow down. But August is normally a quiet month because it's holiday season. Kids are going to school in September. So, you've either moved by then or you haven't. But certainly it seems people are not paying any attention to the normal norms and carrying on their lives, and the race for space is still very much carrying on, isn't it?
And Joe, we saw that Zoopla recommended or thought that there was going to be a 5% increase over the year on house prices. Nationwide, we're a bit more bullish. They said it was going to be 7%, but now they're thinking that with this latest news, they might be estimating up to 9% growth in quarter four. So one wonders whether they really are just plucking figures out the air or whether this is just an extraordinary year that it's just too impossible to predict.
I think we've had two extraordinary years in more ways than we can probably imagine, to be honest with you. And I think it's given a lot of people time to think and perhaps even rethink their own personal family strategies as to what can and cannot happen. And I think it's very important that we got Bob, who's joined us today, because I think some aspects of the mortgage market are playing a huge part in some of these moves that were happening. There are so many underlying issues, and many conversations that I'm having with people when I'm speaking to them are differing and are related to monetary points and thinking about opportunities that are taken. So whilst graphs and statistics give us some indication, they don't always get to the sort of the cold front of what actually happens and why people are doing that. And having gone through the pandemic, having furlough, having working from home, the whole ethos of life has changed. But one thing has been driven throughout that time is property. And I've always said property is at the hub of our life. Every spoke that comes off to support the rest of the wheel comes off of property. So now that people have been buying, you try and get a hold of a builder to come and do an extension. Most builders any good builders are all busy until maybe even at the end of the year. So the market has fueled so many other spokes. The industry, the hike in materials because of the lack of materials that we're not getting is amazing. So the supply and demand of materials is actually really, really low. And so, the DIY stores, the carpet people, the decorate, all of that industry has been driven through the housing market and actually probably to a large extent, Paul, kept sanity because people have had that interest in, doing things to their home. When I drive around and see properties and people, you can see the efforts that they're making on the time and energy they're putting onto their homes. And that's why mortgage is relevant, because some of them are raising money from their property and assets for a number of things. Some are raising it for probably helping the kids to get onto the first rung of the ladder. Some are raising it because they decided to stay where they are and extend. Recently, I had a request from a family where basically they are now looking to add to the existing property so that basically the parents can move into the added part and the children can grow into the family. So instead of actually going out buying more property and as a buy-to-let program, they're enhancing their own living space. And obviously, so there's a huge number of different things that have happened. And the last 2 years have been phenomenal in every aspect, as far as I'm concerned. But it'd be interesting to see, Bob's view on the mortgage side of things.
What we're finding, Joe, is people prefer not to sell. They let their own house and then raise money on it and then buy another one to live in. So that's another cause of the reason why more stock isn't coming onto the market, because people aren't selling their holding. And because prices have done well and they expect prices to carry on doing well, they're gearing up. So they're starting their portfolio journey by not selling the initial house, remortgaging it, releasing capital from there, and then buying a bigger and better house. And that way they start their portfolio journey. And that's another reason why stock isn't coming onto the market.
There's another
Would that be a
suggestion,
let
Bob.
to buy? Would that be a let to buy scheme then, Bob? Because
Let to buy,
sometimes it's a subject that's raised, and a lot of people find it hard to understand that they can actually reverse the situation on there. So maybe you would just take this opportunity to sort of enlighten our viewers a little bit about how that can work and why that has some benefits, and perhaps even some sort of potentially tax benefits? Because are they keeping their own home and therefore not crystallizing the cost on that? Does that help them in that? I mean, it's an area that I'm probably touching on, but it's a question that is often asked.
Yeah, sure. I mean, a let to buy is basically where you let your own house and convert the existing house into a buy to let mortgage. Now that can be done in many ways. You can leave it in your name, or you can sell your current house to a limited company if that's what the tax advice comes out to be. Because if you're a high rate taxpayer, you could set up a company, buy your existing house in the name of that company, and release the equity through that mortgage, if that makes sense. You're effectively selling it to the company. So because you're selling your primary residence, there's no capital gains tax on selling it to the company. The company itself has a lower tax regime. So therefore, as long as you're not taking money out of the company, it's very tax efficient. And also, by selling the house to a company, you don't pay the 3% surcharge on the next house, which you would do if the existing property remained in your personal name, because then it'd be a second asset. So you'd be sort of clobbered by HMRC for the 3% surcharge. So where there's a big jump between the value of your current house and the one that you want to buy, the differential can be quite vast in terms of the saving you can make. Because whilst the company will pay the 3% surcharge, it will be on the lower value house, i.e., the current house, and therefore you avoid the 3% payment on the bigger house. And sometimes that saving alone can be tens and 15, 20,000. So it's one way to start off your journey. But as I've said, if more and more people do let to buy mortgages, then that stock isn't coming back onto the market. So that's, in a way, fueling the prices that we've seen in the report here.
And that's the only product you can use, Bob, to do that, is a let to buy mortgage. Is that correct?
It's a let to buy mortgage. It's a buy to let mortgage, but it's called a let to buy mortgage because it means that you're letting your existing house to buy another one. So, and it falls under slightly different regulation as well. So, because if you've lived in a house, it becomes a regulated buy to let.
We're talking about the lack of stock, and there's something that came up, and it's been mentioned in this report, in this particular article as well, about the fact that we haven't seen the end of the race for space yet. Because although a lot of people got hung up in the whole euphoria of the stamp duty holiday, there were perhaps a wiser bunch who've sat back and thought, well, actually, do you know what? I'm waiting to see what my employer says to me about where I need to be, what my journey into work is likely to be, how many days a week I need to do, whether I'm going to be hybrid or whether I'm fully in back or fully at home. And those are the people that have waited to find out what their needs are going to be. And now they're looking in this autumn period, perhaps into the new year, to make a change. Do you think that's definitely something that's still to happen?
Yeah, I think definitely, Paul. The changes that are happening within the property market, and especially having the benefit of this extended period to the end of September for the remainder of the stamp duty holiday, all of those are going to continue giving us the increase and the demand in the property sector. I think the key thing here for the viewers to understand really is that what funds and what facilities are available for them to continue to do that, and how that would affect. I don't think we'll ever change the mentality of our people here to say that the best form of investment, and ultimately I'd like to buy my own home. That will never change. It hasn't changed in the 40 odd years I've been in the business myself. So I don't think that will change. But what does maybe determine that change is how available and what they have to do, and and that's Bob's territory.
Do you think, Bob, we're coming to, if you remember the 1960s, we had the very first cars on people's front drives. Then we had the two-car family. Do you think we're getting to the two-house family now?
I think we're already there. I think property is such a magnet for investment, whether it's for buy to let or whatever, or even for your own benefit. People do want more space. They want bigger values. It's a sign of status to have a big house. And if you've got a portfolio, that's even a bigger sign of status. And I think parents are realizing that kids aren't going to be able to afford houses in the future. they're just so costly. So I think whilst the parents are able to do so, they're buying property for their kids. So at some stage in the future, they can either sell it to their children, sort of below market value, or transfer it into their names, or add them onto the property itself. Because going forward, if these prices keep on carrying on, it's going to be really, really tough for first-time buyers. I think we'll see a north-south shift again. People are going to be wanting to move further and further up north just to afford property.
And is it becoming easier? Are the products getting better that will allow parents to sell to the children, or allow the children to have the home in their ownership whilst they're still alive? Because up until now, it's pretty much been very much that the parents would have to pass on for the children to inherit the house. So is there a way, there were a number of ones on the market, a number of products on the market, but did seem to be quite a not a particularly financially prudent way of doing it. But is that product starting to evolve?
Yeah, there are lots of products where parents, for example, if they're coming to the end of their mortgage term, and many parents took interest-only mortgages sort of 20, 25 years ago, which are coming to an end, and they haven't really planned for them. They've not invested in any other property or any other investment vehicle. So those sort of situations are now where the parents are having to either add on children or transfer the whole ownership to children. So it is a process. I mean, the children do have to have the right level of earning capacity, but we can either add the children on with the parents, or maybe look at the parents, maybe look at the children on their own. And parents can gift the equity and sell slightly below market value and things like that. So, there are ways and means to shift ownership and pay the mortgage that's coming to an end. So, it's available, shall we say.
And the question I hear from the parents' side of it is that they're worried about their own security in the house. In other words, if I'm giving over ownership, how protected am I in my own home?
Exactly, yeah. We make it plainly clear that if you actually relinquish ownership, you're on a sticky wicket, so by some means or other, do try and retain your name onto the deeds, so that, you can't be evicted by your children, or if there's a subsequent matrimonial split, the children's equity, could be attacked. So these are considerations which we have to go through, and we always say, look, take legal advice before you embark on that journey to give away an asset. But there are ways to protect parents as well, because lenders understand this, and they know that it can be a problem if there's a subsequent matrimonial split. And the last thing they want is, for anybody's parents to be evicted. They also have a social responsibility, a moral responsibility to lend responsibly. So they will ask all those questions in the process.
Great. Thank you for that knowledge. Bob, thank you very much indeed. We need you again for this one. This is one that we had last week, which we thought we'd hold on to because it really did need some inside professional knowledge. So this is a story from last week about home buyers struggling with stringent lending criteria. So we've been talking about the fact that the mortgage market is full of great deals. You can get 95% loan to value now. But according to the company Trussell, they're finding that very few people are actually managing to qualify for these 95% mortgages. The online mortgage broker found that just 1% of mortgage completions were for 95% mortgages. And they're saying that this is basically due to the fact that the lending criteria is such a difficult thing. So, for example, they need higher credit scores. They can't benefit from a gifted deposit, some of the people are saying. Properties like flats and new builds are ineligible for the deals. And in the end, there was something like 26% of all mortgage applications were for 95% deals, but so few of them went through.
Yeah.
Are you experiencing this?
Absolutely, yeah. I mean, 95% mortgages started off with the government sort of launching them with a fanfare, and it was meant to be all the rage. The rates came in at very, very high levels, at 4%, even though they were government backed. So when you compare that to a 75% product at 1%, 4% seems, ridiculously expensive, even with the government's backing. But the good thing is rates have now eased. You can get 95% mortgages now at sub 3%. But yeah, as you say, the criteria is tough. The multiples are pretty stringent. And as you said, some lenders don't like accepted gifted deposits because they feel with such a little requirement, you know, serious home buyers who take their finances seriously should really have managed to save 5% if they're serious about it. Anybody can buy a house with a gifted deposit, but then it's just one extra criteria that the lenders throw in to make sure they're lending to the right people with the right mindset. So they want people who have a proven record of savings and prudent financial management. So and that part of that is obviously a good credit score and no adverse history. So whilst the product is there, it's available. It's not everyone's. It's not open to everyone at all. So we don't do many at all. I think I've done one, and even that was knocked back because they wouldn't lend as much as the client wanted.
I mean, the other thing they're saying is that actually there's a bit of a misnomer here because in 2019 there were 949 95% products on the market in July of that year. And yet this year there were 372. So there's literally a third of the deals that were available 2 years ago with a 95% LTV.
Let me update you on that one because I've just done a search and there's less than 100 right now.
Wow.
If you do a search for somebody buying a house at 250 with a 95% mortgage, a first-time buyer, only 97 products.
That's tough, isn't it?
Yeah, so it's only one of them is sub 3%. Everything else is 3.1, 3.2, 3.3. So they're available, but I think it is I wouldn't really advise because if you borrow 90%, the rates do get better. For the same transaction. So if we assume a 250 purchase price and then put down a 10% deposit and borrow 225,000, the rates, I'm just doing it now as we speak, drop to 2%.
Yeah.
With 435 products.
So it's just if you can get that extra initial deposit, you're going to make your monthly manageable costs so much lower, aren't you?
Yeah, because it's costing you 1% less. So instead of 3, it's costing you 2. So typically one will take a 5-year fixed rate. So you've saved 5% anyway over that 5-year period by paying 1% less per year. So that's your deposit back in a way, isn't it? So if you can somehow muster another 5%, it's to your advantage because you get a far better rate. It's easier to get, and you have a far greater lender choice. 400 products compared to 100, you get far more choice.
Almost seems, Joe, like there was a little bit of government propaganda here, saying all these 95% mortgages are government backed, but actually so few have been done. It just seems like it was a bit of good PR.
Yeah, it's excellent marketing at the end of the day that they did, and it fueled that market that we've all been talking about. These statistics and house price increases and all of those things have been fueled by those things. But the government had an agenda on this, Paul. Their agenda was to build their way out of what they've spent, billions of pounds supporting the country and the people of the country. So they had to find a route that was going to be. And we know historically in all the wars and all the world crises, one way that any nation gets itself out of the trouble that it gets into is through building it out. And so that's the route the government taken. That's why Boris has been saying it's a generation to buy as opposed to a generation to rent. The race for space, these are all words, isms that have come out of this last 18 months, 2 years, in order for people and their mindsets to get into that role and saying, this is the right thing to do. This is the way it is. So 95% mortgages, whilst I agree with Bob's analysis and the fact that it's hard to come by. What it did do is it actually got a lot of first-time buyers, thinking, "Hang on, I can get this. This is much possible." And then if you look at it from a statistical point of view, and I think Bob actually brought this point up in one of our earlier shows, that the savings people are making by not going to the pubs, restaurants, and clubs and on holidays and so forth, they've actually saved one heck of a lot of money towards that 5% deposit, maybe 10% deposit. And in order to do that, what's the best thing? So you're sitting at home when you're searching, your search engine for the right property, and the right deal comes along, and you've got money saved, and you haven't been to the restaurant, and you haven't had a few pints. You start to think, well, hang on a minute, this is really good. Actually, I didn't realize I could save so much. uh, and I've got money in my pocket. So that's what's all of those things combined, in my mind, have been the reason why and the government can see that the restaurants were closed. Pretty much all of the hospitality industry has been on its knees. No one's been out. The only thing that's done well is people like Uber Eats and Just Eat. I mean, they're just fueling it because they're just delivering to your door. That's the market that did really, really well. But the housing market has been fueled because it's the only way, and that's why if you look at the inflationary figures at this moment in time, our inflationary figures are good. The business is good. The UK is doing very well, and it's doing well because all of the related products to the property market have kept the whole thing afloat.
Bob, I've got another story here which really focuses on the mortgage industry, and it basically reveals that the great British public has very little knowledge or understanding or confidence in their ability to negotiate the mortgage market. 64% of Britons believe that lenders do not consider whether an applicant has received support from the furlough scheme in a mortgage application. And basically what they're saying is that 78% of working age adults say they do not have a good enough grasp of the support available to help them buy a property. 76% of working age adults felt they had lack of knowledge about how to secure a decent mortgage, and 80% said they wouldn't be able to identify poor mortgage advice versus good mortgage advice. It is a complicated market, isn't it, Bob, right now, especially with all the lending criteria and all the different products, but the public really does need some help and education.
Yes, I think the industry could be blamed for that because at the end of the day, it's our job to educate people through programs like this and other webinars that we do. And it's also incumbent on the public to actually seek good advice. The worst place you can get your advice from is your own bank or building society, because firstly, they're not going to tell you about other products, and they're not able to give advice. So despite what people think, you cannot go into your building society and ask for advice because they're not allowed to give it. You've got to go to an independent advisor who can look at your circumstances and guide you properly based on what you tell them. But the market is always fluid. There's always changes of criteria left, right, and centre. The pandemic has been chaos for the mortgage market in terms of how the self-employed have been treated. The employed a little bit easier because you're either in a job or you're out of a job. You had to be out of furlough to get a mortgage now. You've got to be actually 1 month back into your job before you can get a mortgage if you have been on furlough. Lenders no longer take a return to date or a letter from your employer to say that you're going to come back on, for example, the 1st of October. They want you to actually complete all of October, show your pay slips, and then, yes, they'll talk to you. But the self-employment is where really the problems have been the biggest, because the self-employed people, as Joe said, hospitality industry, whatever, they suffered badly. And those businesses in the wrong sectors had to take grants or assistance from the government in the form of bounce back loans, council grants, the self-employment income support scheme grants, and those are a red drag to a lender because they tell the lender straight away that this business might have had issues. They've needed to take government help, and therefore they may not be as stable going forward. So every lender has their own take on it. Before, in the early days, the very mention of a bounce back loan meant you got declined. There's no questions asked. You've taken a bounce back. Sorry, we're not interested. But that's now eased because the lenders have realised quite late in the day that people took bounce back loans, but it didn't mean their business was performing poorly. They just took it because it was available, It was
Mm.
cheap money, and
Yeah.
that's what happened. People took them, whether or not they qualified for them or needed them. They took the money and banked it. So quite often that money sat there, and some people who didn't need it have paid it back, quite rightly. But some have actually, used it to sustain their businesses. So where that money was used to sustain the business, lenders didn't like that because they felt, yeah, you needed external support, therefore the business must have been underperforming, and the chances are, if it was underperforming now, it's going to underperform in the future because you're on the trough of your cycle. So they're behaving very, very nervously towards self-employed people. If you were the recipient of one of those grants, they've gone to the extent of checking bank statements for your business. So they don't believe our word or the client's word to say that we're okay now, we're doing well, we're coming out of it. They say, look, put your bank statements on the table. Let's see what sort of turnovers going through the books now compared to what it was pre-pandemic. So there's a lot more onus now on the self-employed to prove the strength of their businesses. So lenders will happily write to the accountants, get certificates, get projections. So it's a fairly painful process. So I'm not surprised the public feel that way.
And a lengthy process as well.
Absolutely.
The survey was of 2,000 people. 42%, so this is your point, Bob, 42% believe that being self-employed wasn't even a factor considered by lenders in a mortgage application. And as many have been, as you've been saying, the high street banks have had real problems trying to lend to, or in fact, they don't even consider furloughed workers and some self-employed people who've taken these particular bounce back loans. So 2.4 million people still on the furlough in the UK. The new poll found that 1 in 20 were currently priced out of the property ladder because they were on furlough, and 9% said that they felt priced out of buying property because they were self-employed. So that pretty much sums up what you were saying there. But that's a real shock, isn't it, Joe? Because as Bob says, people did take that bounce back loan very often because it was cheap money to invest in their business, not to support it.
Yeah, I mean, there are varying stories about the bounce back loans, in all honesty, Paul, Bob, and I'm sure we've heard a variety of them. But it was available. They took it, and they fueled the housing market. Because some people have 5 or 6 companies, and each company had that. I mean, I have people literally walking into me and saying, well, we've got 7 companies. We just taken 50 grand a pop on 7 companies. I'm now sitting on £500,000. What can I buy? And they bought those cash, or they bought them with a loan as a deposit from the loan that they got. Everybody became clever and masterful. Unfortunately, where it's genuine circumstances, that's where they get tarred with this brush of, well, they've taken the money because they might not be sufficient. The truth of the matter is that the facility that the government offered on the bounce back loan was way simpler than ever imagining a 5 grand overdraft facility. I mean, it was just unreal. You literally went online, filled out a couple of questions, and hey presto, 50 grand arrived in your account. I mean, you can't blame the people, and you can't blame the government either. The government was trying to do their thing, and people took it and turned it into the advantages they could. That has been part of the fuel that was added to the housing market, because what was the best thing you could do? I mean, imagine having 7 companies, having £500,000. You go up to the north, you bought 2 houses cash, which are now gone up in prices, and they're doing all right. So, there's a bit of a cycle here that happened. Not everybody did it, I must say, but there were people that did do that. And unfortunately, the ones that did do that, then obviously it didn't help the ones that didn't do it. And that's the price that what people are paying now. But I don't think it was intentional. I think the opportunity was there, and we're all in business of some sort or a shape, and we know that if you want to go out there and in an ordinary, and you're a good citizen, you're a good person, you've got a great credit score, you've done everything by the book, and you go through the bank and say, I need a 5 grand overdraft, they say, the computer says no. Well, here's an opportunity that says I'll give 50 grand. The computer says that yes. Well, what are you going to do? You're going to take it. And that's what's happened,
It was a bit of a lottery as to which who got it and who didn't. Because if you banked with the challenger banks like Tide or Starlink, they weren't giving bounce back loans. So the only people who banked with the high street banks actually got them.
Mm. And I guess in doing that, Bob, that they didn't actually break any terms and conditions, did they? By doing, as Joe suggested, investing in other projects maybe? Was that a criteria that it had to go into the business?
It was a criteria. You use it to sustain your business, not to buy property. So banks were quite careful to check where the source of deposit is. So where it did come from a bounce back, only one lender would look at the applications for that particular transaction. Everybody else said, no, you can't use it for that purpose. And they
Right.
were very, very particular about it. If there was any mention that the monies came from bounce back, they wouldn't lend the money.
Mm. I'm sure there were very clever ways of covering that, though.
Yeah, I'm sure. Yeah, people got around it, but if we found out that it was
Yeah.
bounce back, uh, we had to declare it. So you
Yeah.
can't.
Sure. Okay. Let's move on. Next story. This is interesting because obviously we've talked a lot about gazumping and the prices rising and people's financial prudence going out of the window in the desperate attempt to try and get their property through the stamp duty deadline. But of course, there was one other hurdle that they had to go over in that process, and that's the survey or valuation. And of course, a sizable proportion of properties were downvalued in the past 12 months. Surprise, surprise, where a surveyor or valuer decided on behalf of a lender that the property is worth less than the price agreed between the buyer and the seller. Some 43% of homes were downvalued in the last 12 months, amounting to 390,000 out of 900,000 homes. This happened mostly in all the areas where the price growth was greatest, so Wales, Yorkshire, Humber, and to a lesser extent London. 47,000 out of 80,000 homes across the capital in the last year were also subject to a down valuation. This analysis from Ben and Reeves, and they're saying that the average drop was between 5 and 10,000, with the mid-range being about 7,500, which represents a down valuation of about 2.8%. So even when these prices did get agreed and all the gazumping went on, there was always a sense of correction going on. But what do people do in those circumstances, Bob, if they suddenly find that their valuation doesn't come up to scratch?
Yeah, it happens. What we normally advise is, yes, you then talk to the agent, who will then talk to the seller and say, look, it's been downvalued. Can we renegotiate? Now, given there's probably 10 or 15 people wanting that property, you're probably scared to do that because the moment you start to ruffle any feathers with the seller, you risk the rug being pulled underneath you and the property being given to somebody else. So I think some people have had to swallow those gains themselves. But if you've got a very tight deposit situation, yeah, then possibly you can't buy because generally you could not plug the gap, because the bank will only lend on the lower value, not the higher value. So if you're, for example, taking that 95% mortgage and you've had a £10,000 down valuation, you've got to plug the gap somehow. So if you're tight on money, you're not going to be able to complete the transaction and you may have to pull out unless the seller renegotiates. So this is where I think good relations with the estate agent come into play. They can sometimes put in a good word and you can normally settle halfway house and accomplish the deal. But this is going to happen where agents are so keen to get property onto their books, they will sometimes overvalue it just to get the instruction. And then obviously the banks are very, very knowledgeable about this and they will want to mitigate their risk. They don't want to always accept the estate agent's valuation. So their instructions to the surveyors are to be very, very cautious and make sure they do their homework properly before putting pen to paper and confirming a valuation. So I think it's a couple of things: overvaluation by the estate agents and a bit of cautiousness by the lenders. And guess who gets stuck in the middle? Yeah, it's the poor buyer who has to then juggle the sums and try and get some more money into the bank to actually make it happen.
So, Joe, basically what Bob's saying is it's all your fault.
Well, of course, the buck always has to stop with me. I mean, that's the way it goes, and you can't change that. However, I have to say that I always say that the umpire in this game of cricket is always a valuer, as a surveyor, and whatever they say will go. And in my history for 40 odd years, I've been probably a few times I've managed to persuade them and see their errors in comparable evidence. But 9 times out of 10, their decision is the final decision. And so I classify them as the umpire in our game of cricket, because if they said it's worth 190 grand and you say it's worth 210,000, then unfortunately 190 it is. And as Bob says, then someone's got to plug that. It's not always the buyer that's got to plug it. Of course, it could be the seller, because obviously you've got to negotiate. But if the demand was good on that particular property, then of course that will always fall on the buyer, because it's up to him or her to say, well, I actually really want to buy this property and I've got to find the money. And maybe that's when they go to the bank of mum and dad and say, look, mum, this property's been down value. I don't even want to buy it. There was XYZ number of people there, and the mum and dad will probably stump up the 10 grand or whatever they need to do the deal. Valuation is the ultimate, point where you go through the whole process with Bob, get the application, get your credit score, be passed, and then hope and pray, I suppose is probably the only way to define this, is that the valuer comes back with the amount that you've all agreed to do it at. Because if he or she comes back and says no, then definitely the computer's going to say no, and then you're going to have to start. But yes, Bob is right, and you're right, that in terms of valuation, agents, this is the difference between the private treaty and the auction market. Private treaty sales, agents will continue to outdo each other by simply adding another £5,000 or £10,000 to win the instruction. Sellers actually, Paul, normally know that that's the case, but they are also in it to win it. So they think, well, if that guy says he's going to get 10 grand more, what have I got to lose? I'll try another 10 grand because I can always bring it down. But he's got to be convincing that he thinks. So it's about their conviction and them convincing the seller to say that house is worth more and they've got a buyer. And the truth be known, if they've got it right, then in the first 10 days of a property being on the market, the property's going to sell. There's no question. In fact, even in the first couple of days, because a property is only worth what somebody's prepared to pay for it. And to a large extent, if somebody feels that they've got a property that they want to buy, and you've had 10 people around there within the first couple of days, up to 10 days, that sale will happen. Obviously, it may falter at the point of survey, depending on what issues may have been brought up or whether the value was too high. But if the supply and the demand factors are the ones that are designed to make this happen, then of course, people will do it. And agents will value up because they think, well, actually, I've got maybe a 6-week or an 8-week sole agency agreement. And if I don't sell it in the first 10 days, well, hopefully I'll get the price down and then I'll sell it to somebody else. If they don't price it high enough to get it on, the other fellow is going to do it as well. So that's the bit of a red herring, if you want to call it, within the game. But I think both sellers, agents, and buyers know that. It's just a game that everybody has to play. It's part of the ethos of buying a home. You've got to feel you've had a deal somewhere along the line. But ultimately, the decision lies with the valuer. Of course, the lender as well. But ultimately, the decision lies with the valuer.
Yeah, just to add to that, the process to appeal a valuation is very arduous. It's there's a lot of work to be done to actually get actually sold examples to put forward in front of the valuer to say no, you're wrong, and they don't like to be told they're wrong because they feel they've done enough research to give you that figure in the first place. So an appeal is very rarely successful.
Is it worth, Bob, looking for a different surveyor or a different lender, perhaps?
It can be, yes, because two surveyors could have two different opinions. However, the larger banks tend to use the same 3 or 4 firms. So if it's the same surveyor, you're not really going to achieve that result. You've got to go to a lender who maybe instructs a totally different firm who may have a different view. And some banks don't actually send out a surveyor. They do a desktop valuation. So, you could be lucky. If there's enough data on that street to warrant more or less the figure that you're buying it at, the lender could do a desktop and not even send out a surveyor, and you could get away with it.
On a more general point, Bob, would you say, looking back, say from 2019 to 2021, is it now much more difficult, much more strenuous to get a mortgage for let's just say for the first time buyer who has the funds? Is it harder now to get a mortgage sorted, or would you say it's about the
No,
same?
it's not hard at all if you fit the mold. Yeah, if your credit score is good, if you have the right level of income, the right deposit, then it's easy peasy. But people have issues. They can't prove all their income. They don't have enough income. They might have had a credit issue, yeah, a debt management program in the past, or left some debts behind at university. So you know, it's easy if you've got all the ducks lined up, but it's difficult if you haven't.
Mm, mm. And of course, I suppose there are more and more people with the times that we've had recently who don't have the perfect credit score, etc., because of
Yeah.
various things that have been going on around their lives in this last 2 years.
No, absolutely. Yeah, if you've lost your job and you've fallen behind on your mortgage payments or your bills and utilities, and bear in mind all these are recorded on your credit file, like British Gas and Thames Water, your mobile phone bill. They all form part of your credit profile. So if you're late with those or you miss payments, it's you get a low score and you're not going to get a mortgage. Not the best rate anyway. So.
Mm.
Uh,
I was going to say it's still worth investigating, not just giving up, because you might end up with a higher rate, but you still could get your product.
You can still get the product, yeah. There are products in the marketplace designed specifically for the adverse lending market. The rates aren't pretty, I'll be honest with you, but you can be there be with that lender for 3 or 4 years and then remortgage away. So
Mm.
it's an exile period you've got to do to pay for your misdemeanors in the past. So it's a bit of a sort of suspended jail sentence, if you like.
Mm.
But you will get parole if you keep your credit file clean.
And I guess the advice is to go and talk to someone like yourself, talk to a professional
Yeah.
and a specialist to get the
Talk,
advice and take the best
talk
route
to a
from there.
broker. Yeah. Don't talk to your bank or building society. Then they're not going to be able to help you. So talk to somebody independent who has access to whole of the market, and they can see what your credit profile says about you. What you missed, when you missed, and they can pretty much place you with the right lender from day one.
Okay, great stuff. Good advice as always. Thank you, Bob.
Mm.
Let's have a look at the rental market for a moment here. Generation Rent is a new pressure group, I suppose you'd call them that. They're calling for the end of, they're calling for open-ended tenancies, which should give tenants stability and flexibility, enabling them to put down roots in secure homes that they can call their own. So landlords should pay for evicted tenants to move. Now, this is a situation where a landlord decides that the tenant needs to go because they are either going to move into the house themselves, they're going to sell it, or change it in some way and not rent it out. So they give the tenant the notice to move out. But they're saying that's not their fault. The average cost of that is £1,709, and it should be the landlord that pays that money. This is the campaign group that wants to give renters more security in their homes. In 2019, 57,000 renters were being evicted by a private landlord. 66,000 relocated due to a fixed tenancy ending. 11,000 moved due to a rent increase. When landlords wish to sell or move in, they should pay the equivalent of 2 months' rent towards tenants' moving costs to minimise the stress of moving. Now, of course, what's interesting here is the government has promised a white paper on reform of the rental market this autumn. What do we think about this?
Well, I think from a rental market, the landlord has been battered for the last 3 to 5 years now in all sorts of ways, giving so much privilege and time to the tenants to a point where they're not having to pay for this, they're not having to pay for that, and they want them to pay for this, that, the other, all the way through. What's really annoying about things like that, from a personal point of view, is that tenants want to have the right and the peace and enjoy the property in the right way, but they are just never prepared to put their hand in their pocket to even the most basics of things like cutting the grass on a property, or just dealing with the things. Because if it was their own home, I'm pretty certain they would never leave it and lead to it. And all these evictions and things that happen, Paul, don't happen to good people. They happen to people that really have taken the Michael, extracted the Michael, as they would say, in the first place, and therefore shouldn't be a burden on the landlord, because the reason why he's actually getting rid of them is because they have been nothing but nuisance. Now, if that landlord has a price to pay to get them out, which is going to cost them £1,500, I suppose he's got to take a commercial view at that time and say, this guy hasn't paid me for the last 6 months, and if I have to pay him £1,700 to get him out, then I've got a chance to rent it to somebody else, and at least claw back and make some of my money back. The tenants do cry wolf a lot, but they do bring it upon themselves to a large extent. And yes, there are landlords, there are equally rogue landlords who don't maintain their properties, who make tenants become that way because they don't respond, and don't deal with it, which is why the new generation are not interested in the older properties that the older generation have held. They've been pocketing the money for years and not done any maintenance. And that's when tenants think, well, actually, you know what, the garden fence has been knocked down, the boiler doesn't work, I'm having to call the plumber every other week, and he just doesn't repair it. So then they say, well, if you want to get me out, you're going to have to pay me to go out. So there's, the old adage here, there's no smoke without fire. I don't think there's anything that goes on that doesn't go on because it's a two-way street. But of course, the tenant will cry wolf and say, it's me who's been hard done by. And the landlord says, I've been hard done by because you haven't paid me for 6 months. So, never the twain shall meet.
Well, I mean, the other thing about this that they're saying, Bob, is that, these families that many of whom have lived in these properties for decades, and they've been a good tenant, and they've got family and friends, they've got their business networks around, they've got their children at local schools. When the landlord decides to make a change to sell the property or move in themselves, their life is totally disrupted. And it seems that they do have a point in the sense that they're going to have to pay for the removal. They're going to have to pay deposit on the new place that they go to, which apparently is £808 on average now for 5 weeks' rent. And they're going to have to have time off work to do that, which is estimated at £250 for 28 hours at the minimum wage. There's van hire, broadband installation costs, cleaning costs, etc. It does seem that if the landlord wants to make that change, there is a degree of imposition on the tenant.
There is, yeah, and I get it. It's not nice to be uprooted forcefully when it's no fault of your own. If the landlord wants the property back to live in, or to develop or whatever. I do feel for the tenants. Yes, it shouldn't be like this, but I think it shouldn't be made law. I think it should be more of a matter of negotiating between the landlord and the tenant, and come to some sort of mutual decision. The alternative is, the landlords could be held to ransom or blackmail, and not have their rent paid on time if the tenants get a bit heavy. So I think leave it between the landlord and the tenant. Don't make it law. I think that will be quite detrimental. And the open tenancies, the lenders wouldn't stand for that. The lenders will not let you have an open-ended tenancy because in the event they have to take over the property and then evict the people inside, they need that tenancy to be enforceable. So the 1988 Housing Act only allows a short-hold tenancy to be taken out between a period of 6 months up to 3 years. So, open-ended just won't work. So I think when the white paper is finally discussed, I think it'll be a little bit clearer. But the government doesn't want longer-term tenancies. 6 months or 1 year isn't long enough for family stability. I think people do need to know they're going to be there for 2 or 3 years at least, to give them some decent lifestyle or expectancy that they'll stay there and not be kicked out next year.
Well, gentlemen, I have to say that one of my few jobs on this show is to make sure we keep an eye on the clock, and I'm afraid the clock has beaten us for this Sunday morning, so we're going to have to leave it there for this week. Joe, thank you as always, and in particular, this particular week to Bob for your excellent advice on all matters mortgages. Chess Mortgages is Bob's company, and we urge you, if you'd like some expert advice, to go and speak to Bob about mortgages, similarly, of course, to Joe about anything to do with matters auction or estate agency and property in general. So thank you, gentlemen, very much indeed. We'll look forward to seeing everybody again at the same time next Sunday.